The role of predictive analytics in financial forecasting. Predictive analytics is a vital tool in financial forecasting, utilizing time series analysis to guide decisions across economics, finance, and business management. Time series analysis examines data points collected in a specific order over time, allowing analysts to identify patterns and predict future values based on historical trends. In finance, data points are usually collected at consistent intervals. Common examples include daily stock prices, monthly interest rates, and annual sales figures. One major challenge with time series data is its sequential nature. Unlike other types of data, where observations can be independent, time series data requires a different analytical approach. Steps in time series analysis. The time series analysis process consists of several key steps. First, analysts scrutinize the data to uncover trends, seasonal variations, cyclical components, and irregular fluctuations. Understanding these components is crucial for developing effective forecasting models. Trend analysis is typically the initial focus. This step involves identifying long-term movements in the data, indicating persistent increases or decreases over time. Recognizing trends allows forecasters to make long-term predictions and interpret shorter-term fluctuations within the context of these broader patterns. Seasonality refers to regular patterns, such as increased sales during holidays or fluctuations in stock market volumes. Analysts often adjust for seasonality to focus on underlying trends and cycles, eliminating these predictable effects. Cyclical components represent irregular fluctuations driven by broader economic conditions, such as business cycles. Unlike seasonal patterns, cyclical variations are not fixed and can vary based on various external factors. Forecasting models. Once the components are identified, analysts can employ various forecasting models tailored to the nature of the time series and specific analytical needs. Commonly used models include ARIMA, Autoregressive Integrated Moving Average. This versatile model forecasts non-seasonal time series data, integrating autoregressive terms, differencing to achieve stationarity, and moving averages to smooth past errors for future predictions. Seasonal ARIMA, SARIMA. An extension of ARIMA, SARIMA specifically addresses seasonal components, making it ideal for datasets with strong seasonal effects. Exponential smoothing. This method applies exponentially decreasing weights over time, making it effective for volatile data without a seasonal pattern. Profit. Developed by Facebook, this forecasting tool combines yearly, monthly, and daily seasonality with holiday impacts to model nonlinear trends. Predictive modeling for stock prices and market trends. Predictive modeling for stock prices and market trends is a complex yet fascinating area of finance. It employs statistical and machine learning techniques to forecast future market behaviors, which is essential for investors, financial analysts, and portfolio managers. Effective predictive modeling significantly influences strategies, optimizes returns, and mitigates risks, making it a crucial tool for financial decision-making. The foundation of predictive modeling lies in analyzing past data to identify trends that inform future outcomes. Algorithmic trading strategies based on predictive analytics. Algorithmic trading strategies that utilize predictive analytics are transforming finance, enabling faster, data-driven decisions. These strategies use advanced mathematical models to forecast market movements and execute trades at optimal times, aiming to maximize returns and minimize risks. The core of algorithmic trading is its ability to process complex data sets and execute trades swiftly. This involves various statistical, machine learning, and econometric techniques that reveal trading opportunities based on patterns not immediately visible to human traders. One common approach is statistical arbitrage, exploiting price discrepancies between correlated financial instruments. Trend following is another prevalent strategy. By leveraging predictive analytics, this method detects market trends and places trades that align with them. Market making is also enhanced by predictive analytics. Market makers facilitate liquidity by buying and selling financial instruments close to market prices. Predictive models help assess supply and demand dynamics, predicting short-term price movements for optimal trading. Risk assessment and credit scoring models. Risk assessment and credit scoring are crucial in finance, helping institutions manage risk and make informed lending decisions. These models assess the likelihood of borrower default, ensuring stability and profitability for financial enterprises while aiming to make credit accessible and affordable. Traditionally, credit scoring analyzed financial history, income, and debts. However, advanced statistical methods and machine learning have expanded these models, incorporating more data points and sophisticated algorithms for improved accuracy. Initially based on logistic regression, modern models evaluate factors such as age and debt levels to compute default likelihood scores. As financial markets have evolved, so have the models. Techniques like random forests and neural networks can identify complex relationships and handle larger data sets, revealing strong predictors of financial distress that traditional methods might overlook. Additionally, alternative data, such as rental and utility payments, helps assess borrowers with limited credit histories. Real-time data analytics also enhance risk assessment, allowing institutions to adjust credit scores dynamically based on a borrower's economic activities. However, challenges remain, including regulatory compliance and ethical concerns regarding privacy and automated systems. The future of credit scoring lies in continuous improvement, integrating new data types, and developing regulatory frameworks that promote fairness and transparency. This evolution enhances financial decision-making and fosters financial inclusion, empowering individuals to manage their economic futures. Predictive analytics in fraud detection. Predictive analytics is essential in combating financial fraud, enhancing how institutions protect assets and maintain customer trust. With the shift of transactions online, traditional fraud detection methods have become inadequate. Predictive analytics anticipates fraudulent activities, allowing proactive measures. Fraud detection identifies unusual patterns deviating from expected behaviors. Historically reactive, institutions now use predictive analytics to analyze trends and detect potential fraud before it occurs. The process begins with data collection from various sources, ensuring accuracy through data cleansing. Decision trees classify transactions based on historical fraud rules, while neural networks identify complex patterns and relationships, outputting probability scores for potential fraud. Anomaly detection, through clustering, flags transactions that do not fit typical patterns, effectively spotting new fraud types. Integrating predictive analytics into fraud detection allows for quicker, more accurate identification of fraudulent activities, reducing losses and preserving customer trust. These systems can adapt to evolving fraud patterns, essential in a changing threat landscape. However, challenges include the need for continually updated models, the risk of false positives, and ensuring data privacy and security in compliance with regulations like GDPR. Looking ahead, predictive analytics will play an increasingly significant role in fraud detection, with advancements in machine learning and artificial intelligence further enhancing system capabilities, equipping financial institutions to tackle evolving fraud threats effectively. Enhancing customer insights with predictive analytics. Predictive analytics has transformed how businesses understand and engage with customers by accurately forecasting behaviors, preferences, and future needs using sophisticated data analysis. This involves leveraging historical data through machine learning and statistical methods to predict future events, enhancing customer insights. Key applications include personalization, where companies analyze customer purchase history and online activity to tailor marketing messages, significantly increasing engagement and satisfaction. Additionally, predictive analytics improves customer segmentation, allowing businesses to group customers based on similar behaviors and preferences for more targeted marketing strategies. It also plays a critical role in customer retention by identifying signals that a customer may be at risk of leaving, enabling proactive measures to maintain a stable base. Moreover, predictive models enhance customer service by anticipating potential issues, such as service disruptions, and facilitating timely interventions. However, challenges persist, particularly regarding data privacy and security, as organizations handle sensitive information while adhering to regulations like GDPR. Successfully implementing predictive analytics requires overcoming obstacles related to data integration and synthesis to create a unified view of customers, necessitating advanced technical skills and organizational alignment.